Okay, so we've been doing some reaction videos, expressed opinions out there of Dave Ramsey, who we're tending to pick on these days, is related to whole life insurance, all right? As I always say, you know, I do applaud Dave's efforts to help people escape bad debt and to limit excessive spending. Where we take issue is a lot of this generalizing about costs, not distinguishing between sort of bad expenses and good protective expenses. And so we want to add some clarity to that for people that are researching options. Let's dive into the video.
I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Jason is a caller that calls into Dave's show. And this particular video is just like, the reaction is almost visceral to the idea of infinite banking. You know, Dave is very unhinged about his opinion on this, calls whole life horrendous.
So when the company makes a profit, the policyholders receive a dividend, as if they were a stockholder and received a dividend.
So let's jump into the first point that Dave makes, and it's really about dividends. He tries to land on dividends and hope that he can shoot holes in the idea of whole life, mutual whole life dividends. The reality is that he's simply, not correct in his understanding of the dividends. He uses the IRS definition, which is really these dividends are a return of premium, and from that basis, he concludes that folks, are simply overpaying and that they're getting their money back. But what he's missing is that the whole life company invests, the premiums, right? And they need to do a good job if they're going to pay dividends. And they're mostly investing in guaranteed corporate bonds. And if they do a good job and they're motivated to do so, then in a mutual whole life company, the policy holders are the owners, right? And they get that money back in the form of a dividend. We want these dividends classified as a return of premium because they're essentially tax-free at that point. So the thing with whole life dividends, when they go back into a policy, is you locked them in with the guaranteed growth of a policy and continuing to build your cash value. You locked in your dividends. You could theoretically, if you have a dividend paying stock and reinvested those dividends, you could lose the dividends when the stock value declines. The other aspect of the growth of a whole life policy is guaranteed growth. And so you get dividends, plus he doesn't talk at all about the guaranteed growth that you get with the policy, which is actually the larger component to growth within cash value in a mutual whole life policy. Moving on, second point, Dave talks about, I find this one really entertaining. He talks about real financial advisors.
Dude, you need to get away from them and you need to go get a real financial advisor that can help you do some real investing.
As an estate planning attorney, I've worked with hundreds of advisors over the years. I can tell you that this isn't the kind of situation that Dave's painting of a group of priestly, choir boys over on one side and evil devils on the other side, on the insurance side. So in reality, it's all a matter of the person. You have insurance people of great integrity that care about their clients, do a great job designing policies, and you got financial advisors that don't do anything, that charge that 1.5% fee. That's just the reality of it. Guys, if you're listening, you're looking for trusted advisors. If you think that's Dave, that's great. But the thing is, you have to understand, he's painting a very biased picture in terms of advisors. Reality is, most financial advisors can do financial products, mutual funds, and they also have the ability to sell insurance. They have insurance licenses. So you just need to know, there's no real financial advisors. The other thing that I saw in another video with the colleague, Gary Gunderson, recently, is that, he talks about what is a real financial advisor. It's someone that takes the whole picture in mind, right? So do you have trusts? Do you have wills and trusts? How's your spending going? What buckets do you have? Have you diversified? I don't think I've heard the word diversify from Dave's lips. Okay, third point. Dave basically refers to this as a horrendous product no one should ever own.
These products are horrendous. Yeah.
Dave is basically relying on, I think, some kind of definition of whole life insurance that is probably 50 years old at least. You know, he's looking back at traditional whole life policies and just locked into that definition. And what is that he's really thinking about? He's talking about a standard design base premium whole life policy where it takes a long time to build up the cash value. You know, so what we're really talking about is strategically designed high cash value mutual whole life. We prefer that. We also, you know, as a platform, we also consult with people on IULs and different products, but sort of the preferred is this high cash value policy, paid up additions where you're putting extra cash into the policy. And interestingly, with these policies, you're also doing what's called a term rider, which Dave should be madly in favor of since he loves term life. You know, you're actually adding some term in there. You need to get the facts on that. You need to look at these policies and how they work. Fourth point, Dave mentions policy loans. He says you're borrowing your own money.
Right.
That you're borrowing your own money and you're paying them interest?
In this case, the insurance company is basically giving you a policy loan and using your cash value as collateral. All right, so it isn't, you're not borrowing your own money. You know, the thing about borrowing in a policy loan, which we've done whole webinars on policy loans, is that policy cash keeps working with guaranteed growth plus dividends. We've looked at the numbers on this. Another point that Dave really tends to talk about fairly commonly is this idea that you lose all your cash values.
Your cash values that are sitting there all die with you. So whatever cash you put into this is equals zero at your death.
This is another huge misnomer. And again, I think it is based on an outdated understanding of whole life policies. When you do a high cash value policy, that cash value is going to continue to exponentially increase the death benefit over time. So Barry and I also did a webinar on this one where we looked at an illustration where somebody was putting $20,000 a year into a policy. All right, and what happens when you do that is, you know, there's going to be a term blend in there. But what we did is we looked at it over basically a 26-year period, and at the end of 26 years, in that particular case, there was 2.2 million death benefit. Yet the face value of the policy plus the cash was about 1.6. So which would you choose? But in reality, these modernly designed policies are going to be accruing death benefit over time. And you can look at the numbers. And again, in the early years particularly, you're going to have a term blend, which is you basically have death benefit that is going to cover in way in excess of what your initial investment is. So what we think is that, Dave, you can do better in terms of understanding these policies. You know, we know that you like term. As an estate planning attorney, I can tell you I'm somewhat averse to term. The statistical fact on term life is that the death benefits are hardly ever paid out because the term expires. I'm going to reiterate my point. Just, if you're listening, look for trusted advice in these areas. If someone doesn't understand an asset, you certainly don't want to just accept their advice without digging in a little deeper and getting that information. So with that, guys, I encourage you, check out our other webinars, and we'll see you in the next video.